Options traders who use indicators to determine trend and momentum have ways of increasing the odds of a trade winning and increasing the size of those wins by using their options trading knowledge. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders on our desk are trained in all aspects of options trading techniques so that they can use those techniques to take advantage of market situations that arise. So if you're interested in increasing the odds of an options trading win and at the same time giving yourself a strong shot at increasing the size of that win, then stick around because I think you're going to find this useful. Hi, I'm Seth Freuberg. I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so many of you are experienced traders, and you've probably heard of the RSI indicator, a momentum indicator that measures whether an asset's price is, at least temporarily, too high to be sustainable, which is known as an overbought condition. Or conversely, the indicator may signal that a stock's price has been driven down to the point where there are buyers readily willing to scoop the shares up at that price in what is known as an oversold condition. RSI readings over 70 are generally considered to be overbought conditions, and RSI readings under 30 are generally considered to be oversold conditions. So, for example, let's take a look at a chart of CMG, Chipotle Mexican Grill, since the pandemic crash in March of this year, and you can see it was in a strong bullish uptrend through the beginning of June. So during such trends, traders like to wait for pullbacks that allow them to get into a long position on a stock at better prices in what is otherwise a strong uptrend. Now, let's zero in on the first few weeks of June. And as you can see, CMG stock had temporarily pulled back, and as a result, it has crossed down below the 30 reading, which, as we mentioned, is generally regarded to be a bullish oversold condition. Now, before we get into how we're going to use options to take advantage of this opportunity, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with the stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. I just want to make sure that everyone watching this video is clear on how equity call and put options work before we go any further. If you already know this stuff, then just hang in there. This will be quick and we'll get right back into how this strategy works. So what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock is going way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below the market. he could flip them the next minute and make a huge profit on those shares in that case. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the strike price has gone way below the strike price of the put, which of course saves him a lot of money compared to whether he didn't own the put and he's stuck suffering a much larger loss on his shares because their price has gone way below what they were worth, but he had no protection against that happening. So all other things being equal, when a stock price goes up, a call option for that stock will go up because that right becomes naturally more valuable to the buyer. And when a stock price goes down, a put option for the stock will go up because that right naturally becomes more valuable to the buyer as well. So those are the basics of call and put options. Let's take a look at what happened on June 10th when the RSI on CMG dropped below 30 into oversold conditions. Well, at that point, there's a trading technique where you'd move out to an options chain about a month later, in this case, exactly a month later on July 10th, and because oversold conditions imply that a bounce is coming, the trader would buy a call a little bit above the market price. In this case, the 1045 strike, which is about 20 points above the current CMG price of 1027. Now, you can see that the call is priced at $40.30, although remember that represents 100 shares of CMG stock, so the total outlay in cash is actually $4,030 for the call. Now let's move forward to the next day, and as you can see, CMG dropped down to 1,000, another 27 points below the initiation of the call purchases the previous day. And so when this happens, the stock is considered even more greatly oversold. So that's when knowledgeable options traders take advantage of the situation by selling what is known as a put credit spread. So let's see how this works. So the trader will normally give the trade a little bit of room should the market sell off a little further. And so let's say he heads down 50 more points to the CMG 950 put strike, and he sells that and then heads down another 50 points to the 900 strike and he buys that. Okay, so let's first take a look at what's now happened. Interestingly, at this juncture from a cash flow standpoint. So remember, the original call that we bought had a total cash outflow of $4,030. And the next day we sold that put credit spread and received $13,720 for the 4 short puts at 950 while we paid out $88.80 for the 4 long puts at 900. And so the total result is positive cash flow of $810 after having executed these transactions, which by the way has a total risk of over $15,000. And that's exactly what your broker will margin you for this trade. Now let's move forward to the next Monday, which is a week after we initiated this trade. And as you can see, CMG has rallied to 1070, pretty much as the indicator predicted. And so for a bullish trade using the RSI indicator, you typically exit at this point, as the indicator is essentially flashing a warning signal that this condition that you bought is about to end. And so we would want to exit at this stage. So we would just close the trade at this point with the pricing that you can see in this illustration. So we sell off the 1045 call, which had appreciated, buy back the 950 puts to close that short position, and sell the 900 puts as well. Now, let's do a cash flow analysis to see what the outcome was. Well, first of all, remember, we had that positive cash flow from selling the 4 puts and then paying for the long puts and the long call. So that is the starting point of the calculation, since we get to keep that 810 no matter what. Well, with CMG having rallied past the strike price of the 1045 call option, that option is now what we call in the money by about 25 points. And so its value would have increased greatly to $49.49 since we first bought it for $40.30. So by selling that, we bring in $49.49 in cash. Now, it costs us $3,500 to buy back those 4 950 puts, but remember, we got in $13,720 for those originally, so we made a killing on those. And then finally, we do cash in on the remaining value of the 900 puts, although we sold them for much less than we bought them. But when you net everything down, we made over $4,000 in 12 days, which against what our broker margined us was a return of 26%. Now, there's one more important point I'd like to bring out. Suppose that we decided for whatever reason to hold the trade until expiration, and that instead of CMG rallying after we entered into the trade, that instead CMG sold off down to, say, 1,000. Well, in that case, the long call is worthless, right? After all, who's going to exercise a call to buy the shares for 10.45 when they're worth less than that on expiration day? Obviously, no one, and so that call has no value and expires worthless. But at 1,000, something else interesting has happened, and that is that the short put at 950 and the long put at 900 also have no value. They also expire worthless because no one's going to exercise the right to sell their shares for 950 or 900 if the stock's trading at 1,000, obviously, so those puts have no value as well. So in other words, all three options expire worthless, and you get to simply pocket that original cash flow. In fact, at any price above 950, you make at least your initial cash flow of $810, and at any price above 1045, you'd make additional profit for being able to exercise that call and sell the shares for a profit instantly if you wish to. In other words, even if you entered into a bullish trade and were wrong, as long as the stock didn't sell off down to 950, you still made a pretty nice profit in 12 days. So what I'd like you to take away from this video is that using the RSI indicator may be helpful now and then to time entry and exit points on options trades, no doubt. But additionally, through the use of the put credit spread, you can add an important element of profit into the trade that the long call alone would not have provided, while opening up the intriguing potential for you to make a profit on your bullish trade, even if the market sells off from your initial bullish trade entry. It's those kinds of creative ways of utilizing options that make professional traders on our desks so excited about the different ways that they can express their trading ideas through options. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that the professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you could just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on our subscribe button right now so you won't miss all the free trading videos that we're posting constantly on our channel to help you to improve your game as a trader.